Thank you, Mr. Chairman. There's been an awful lot of discussion about whether we should regulate. There's been a lot of discussion about who should regulate, and much less discussion about what the regulation should be. Let's assume, for the sake of the argument, that we agree that something went badly wrong in the case of AIG, and that bailing out AIG is not the best use of $100 billion of taxpayer funds. Somewhere along the line, somebody should have had the authority and the guts to say to AIG, you're doing something wrong, you need to stop. And what I want to hear from you all is I'd like to hear your best ideas about what the substantive rules should be in order to avoid a recurrence of the situation that we've had with AIG. And I'm talking about specific limits, because I'm concerned that if we simply say to a systemic risk regulator, you figure it out, that's not being responsible. So we have to come up with rules that we can actually apply with some degree of regularity and avoid the problem that we've seen over and over again in this industry, which is capture, where the regulated becomes the regulator. So let's start with Mr. Hunter. What are your best ideas about when to tell AIG or any other insurance company that enough is enough?
Well, again, I think this is the role of a solvency regulator, solvency/systemic risk regulator, and that there should be specific limits on leverage.
What limits?
Well, it may depend upon the line of insurance. I mean, it does depend upon the line of insurance. If you're writing earthquake, you need a lot more capital than if you're writing life insurance.
Give me an example of when you would say enough is enough.
For earthquake insurance, I think you need at least $2 of capital for every dollar of risk. For property casualty insurance, you may need only $1 for $2 of risk. Depends on the line of insurance there, too. So you can come up with leverage limits. You can come up with size limits. I mean, some companies shouldn't grow beyond certain limits, particularly in markets. 10%, maybe a limit should be 10% within a line of insurance. For example, in a state, no company should get bigger than that, so that to enhance both competition and to make a failure less damaging.
Is there a certain size when you think that enough is enough, when it actually is beginning to invoke systemic risk? I mean, we know that a $1 million insurance company is not involved in systemic risk, and a $1 trillion insurance company is. Yeah. Tell me where you think the line is.
I don't know. I haven't done the analysis, but I think it can be done. And again, it may vary by where you're writing and the kinds of risks you have in your portfolio.
Mr. Harrington, when is enough enough?
I'd like to think I would know it when I saw it, but I would not be able to opine on that outside of the context of what in particular I was looking at. Clearly, it seems to me that someone with knowledge of what was going on at AIG should have been able to say enough is enough. Nobody did.
You see, Mr. Harrington, that's the sort of fundamental problem, because if you were the systemic risk regulator and you were faced with this situation, unless you had clear rules to apply, you might just say, I'm just going to not deal with it. And that's the problem we're going to face unless we come up with specific rules. So let me hear from Mr. Webel what you think the specific rules should be.
I really don't have... the difficulty is that the financial services industry is mutating so quickly. Writing specific limits into laws puts you in a very difficult situation. I think that looking at market share is probably a reasonable place to start, but in doing that, to some degree, you are also cutting off consumer choice. I mean, if an insurance company is doing a great job and I want to buy insurance from them, and then the government comes along and tells me, oh no, you can't buy from them because too many of your neighbors did. So I would really like to have a good number to tell you, but I'm sorry I don't.
Mr. Grace, when would you put your foot down?
I can't answer it directly, but I can give you an analogy that I think works really well. 20 years ago, when Congressman Dingell had his hearings, he put the insurance regulators to the test. And they came up with a system, and I said, this is the thing I was criticizing before, I think it has a patina on it now, but it was specific rules that happened when certain things occurred. And the regulator had no choice. Or its choice was constrained. You know, he had to either shut it down or he had to investigate it, but it was something that had to be done. What we're talking about here, there isn't a rule that is applicable to every single company universally. Something else I also said was that the Europeans are going to this capital model, and they are putting all of the firms within an enterprise together to assess the type and the quality of capital and how it's going to support the risk that it's writing. And it may be that that test can be used in a, what was the risk-based capital rules, what I'm talking about, but there were mandatory requirements that the regulator had to engage in when certain things occurred. Science has to be developed to develop those rules for current insurance and insurance-like enterprises. We don't have it yet.
Well, my time is up, but I will invite you to supplement the record and tell me directly what your best thoughts are on the subject. And I honestly find it a little disconcerting that 5 people who are experts in the industry and could end up being the systemic risk regulators for insurance, any one of you, would find it so difficult to answer a question like that. I'm not blaming you for it, but I think it illustrates what a conundrum we're facing here, and I want your best thinking about how to solve it. Thank you, Mr.